Nancy joined HUD in 2004 as an underwriter. In 2006, Nancy became one of 4 marketing and outreach specialists in the country and assumed her current position in 2015. Nancy works out of the Santa Ana Homeownership Center, which services the 8 western United States and travels extensively providing presentations, information, and panels like this. We're so excited to get an update of the FHA programs. She works with elected officials and staff in other divisions within HUD. Nancy holds a Bachelor of Science degree in education with an Associate of Science degree in real estate. Nancy has been in the real estate industry since 1977, holding a California broker's license since 1989. Nancy resides in Southern California with her husband, and I believe this will be the 3rd year that Nancy has come to visit us. It took about 12 years before that and an act of Congress for FHA to actually appropriate the money to send somebody all the way over here to Hawaii. We've discussed that before. If you were going to Cleveland, it's really easy. You can go all the time. But coming to Hawaii is a little more difficult. But we really appreciate Nancy coming for the 3rd year in a row. We can't thank you enough. Let's give a big round of applause to Nancy West. Next to Nancy is Cherie Castanares, and Cherie is a senior loan specialist at the Veterans Administration here in Honolulu. She was born and raised here in Hawaii. She graduated from Honolulu High School. Cherie was employed full-time with the Hawaii Air National Guard from 2003 to 2009. She worked as a KC-135 flight line crew chief until 2006, and then worked as a controller in the Maintenance Operations Control Center. After leaving the National Guard, she worked as a realtor with Prudential Locations at the time. In August 2012, she was hired as a loan specialist at the VA. She's now the senior loan specialist in the Honolulu Regional Office. I believe this may be the 3rd year that Cherie is joining us, and we thank you so much for coming again. Please, a warm round of applause for Cherie Castanares. Next to Cherie is Joseph Lorinc. He is the VA staff appraiser, has been with the Department of Veterans Affairs since October of 2015. Joseph has been a certified general real estate appraiser since 2008 and was first licensed as an appraiser in 1993. Prior to a brief employment with the State of Washington Department of Transportation, Joseph was the owner of Neapolitan Appraisal Inc. in Naples, Florida from 2007 to 2015, and co-owner of Gulfside Appraisal Inc. from 2003 to 2007. Joseph's current responsibilities as a staff appraiser with the Department of Veterans Affairs include writing appraisal reports for the Native American Direct Lending Program here, management of the VA fee appraiser panel members, review of independent fee appraisers' work product, review of staff appraiser reviewers' work product, and issuance of VA notices of reasonable value. During Joseph's career as a real estate appraiser, he has performed appraisal assignments on a wide variety of residential, commercial, and rural properties for mortgage lending and expert witness testimony. As an expert in real estate appraisal matters, Joseph Lorinc's opinions and suggestions were introduced and published as part of the Federal Reserve's hearings on the formulation and implementation of Title 14 of the Dodd-Frank Act. So we're very, very fortunate to have Joe with us today, and we really appreciate you coming. So once again, a round of applause for Joseph Lorinc. So what I'm going to do now is I'm going to turn it over to our panelists. I guess we'll start with you, Nancy, and we have 2 mics and 3 people, so if you want to just share the microphone. We'll start with you, Nancy. If you could just give us an update since last year, I guess, of what's happening in FHA. Then we'll have Cherie and Joe give us an update, and then after that, we'll open it up to questions. So thank you so much, Nancy. Take it away.
Okay, good morning. I'd like to start out with saying the U.S. Department of Housing and Urban Development would like to thank the Hawaiian Mortgage Bankers Association for inviting us here today to provide you an update on FHA and FHA programs. Mahalo. So I'm going to start off with the handbook. The handbook is a challenge. For any of us, you heard how long I've been in the business, it's difficult to get around. I do recommend, however, that to utilize the handbook, go to the online handbook. Do not use the PDF version, because the PDF version pages do not match the pages in the online handbook. While the handbook is complete and concise, and it takes you from origination all the way through post-closing servicing, where you think you might find things, you're not going to find it. So, I have a simple approach to find what you're looking for, and that's to use our frequently asked questions page. If you use the frequently asked questions page, which is at www.hud.gov/answers, and do a keyword search. Don't try and look for it based on the section of the handbook. Use a keyword search. You'll be able to find what you're looking for, and when you open up the question, it provides you with the answer and where exactly it is in the handbook. Let me give you an example. Water catchment. Water catchment may be acceptable, but it is on a case-by-case basis only. So those of us that are underwriters or loan officers or in management would think that anything dealing with the property, such as water catchment, would be found in the appraisal section of the handbook. It's not there. It is in the section of underwriting the appraisal. So while we've made it complete and concise, it's not where you think it will be. So the keyword search is probably the best way to find what you're looking for. We issued an update. If you're not aware, we issued an update yesterday to the handbook. We made some changes in that handbook that were not published in mortgagee letters. What we did is we provided some clarification. All the mortgagee letters are to be uploaded, and they are in the online handbook as soon as they're published. However, there are other areas that we've made further clarification in within yesterday's release. With yesterday's release of the handbook, we also issued updated training modules. On your lunch tables in the back, I brought with me some handouts for you. One of those is the modules and the link to the modules. The modules, what we've done in those modules is because last year when I was here, it wasn't published yet. The handbook wasn't published yet. So what we've done, I know reading that handbook could be extremely boring. It's like 944 pages, right? It's extensive. So what we've done is we've broken it down into these training modules, and it follows the handbook, word for word, line by line, page by page. So what we've done is we've taken staff throughout the country, and we've created these modules, and we've read it to you from start to finish. Now, it's not as boring as us just reading you a book. What we do is, as we're presenting the material and reading it to you, we're also giving you examples along the way. If you decide to listen to any of the modules, you might recognize a voice. I'm not going to tell you which module, but you'll recognize a voice. I want to talk about condominiums, right? Condos are a big issue here in Hawaii. And as you know, 3 years ago when I was here with Joanne Kuzma, we told you we were working on the rule. Last year, I told you we were working on the rule. This year, I'm telling you we're done with the rule at this point. The rule has been sent over to OMB for comments, the Office of Management and Budget. We know that it went over on May 7th, and OMB is working on it. We know that because we're already getting questions back from them. We're also understand when we propose a rule and are going to send it out for public comment, other federal agencies have a right to look at what we're posting because it may affect their programs as well. For example, we know that SBA is looking at it. Now people say, well, why would, and they're asking us questions, why would SBA be involved in what we publish for condominiums? Well, because you could have a small business owner that's a condominium builder. And if SBA requires certain performance dates, but it conflicts with what we have in the new condo changes, we may have to alter the rule. So we're not looking for that rule to come out until maybe the beginning of the year. When it comes out, you do need to look at it, you need to comment. Now, I've said this the last 2 years, I'm going to say it again. When we propose a rule, your industry, the industry associations, your trade associations that you work with, they're going to comment for you. but they're gonna comment on this level. They're not on the ground, they're not in the trenches, they don't work with it day to day. They're only concerned as a whole, right? Not your individual issues. You need to comment if there's something missing, if there's something that really is gonna alter the way that you do business. For every comment we receive, we've got to respond. It may or may not make a difference. We may change how we have it written, but you need to look at it and you need to comment. Moving on, we have some temporary provisions in place, one of which we announced in November at the National Association of Realtors Convention. We've added some temporary provisions to condo project approval requirements. One is we are now counting secondary residences as owner occupied. Now don't get excited, that's not second homes, okay? And I know you have a huge second home deal here in Hawaii on all of the islands. I'm talking true secondary residence. A secondary residence is someone lives on Kona, the whole family is on Kona, their job moves them to Honolulu, right? And rather, maybe they've got kids in high school, and the kids are they've grown up there all their life, they want to graduate. So the person comes over on Monday to work in Honolulu, flies home on Friday, right? Rather than pay for a hotel room during the week, or pay rent in an apartment, why not make an investment so they buy a condo here, right? To build something up, at least they're not giving their money away. You're now trying to get this project approved in Honolulu. If that's a secondary residence, it's a residence out of necessity. It's a secondary residence out of necessity. That can be counted as owner occupied. The other thing we did with that temporary provision is we're now allowing for blended insurance. When you have a master plans community, many times the master association covers 80% of the insurance because we require 100% liability on the project. The master covers 80, the homeowners association makes up the difference. That was not allowed before. We are now allowing for blended insurance. The only thing is the homeowner cannot pay to make up that difference. But if the master has 80, the homeowners association for the condo project has the 20, that's now okay. The other thing that we allowed in that temporary provision is, and by the way, the temporary provisions that are currently in place will be extended. I was informed of that last Friday when they come up for renewal because the rule is in the works and we're hoping to get it published. All the temporary provisions will be extended to satisfy, to match up to when the rule comes out. The last thing that we did with the temporary provisions is we're now making it easier for condo projects to recertify. I'm going to tell you, right now you have 40 projects for all of Hawaii currently approved. Okay? That doesn't mean that there were not more. Since we changed the condo approval process in 2010, we know that 96 other projects have already come in and they've already expired and they've already dropped off the list. Which tells us that somebody needed a loan in there at one point, the project got approved, and now it's gone again. And the next time, they'll probably do the same thing. So what we've done under this temporary provision is we're now allowing projects to recertify. They have to recertify within 6 months of their expiration date, and they have up to 6 months after their expiration date to recertify. The recertification process is really easy now. Rather than sending everything in again and starting from scratch, all they need to do is send a few documents. One is the certification that the owner occupancy is still there, that not more than 30% of dues are 60 days in arrear, that the insurance is still in force. The only other thing that we require is if they've changed any of their legal documentation. So if they've made a change to their CC&Rs or did an amendment to the bylaws, then that legal documentation would be required. But otherwise, it's really simple to recertify a project. So keep that in mind moving forward. I'm going to talk about two more things and I'm going to turn it over to my other counterparts. The HECM rule, the Home Equity Conversion Mortgage Rule, was published on May 8th. Y'all have, for those of you that are involved in reverse mortgages, you have until July 18th to post your public comments. That program is being tightened. We expect nationally a loss of $1.9 billion in HECM endorsements per year moving forward. As you know, currently, well, maybe you don't know, for those of you that work in the HECM world, there's the required set-aside when the borrower is incapable of meeting their financial obligations for the property taxes and insurance. Under this proposed rule, there is a requirement for an additional set-aside for property repairs, right? So there are some things that are going to majorly change that reverse mortgage program. However, the program is there. The intent is to help the senior citizens stay in place, remain in place for those people that cannot afford to move somewhere else. That's all they have. Helps them with their medication, helps them with maybe nursing assistance in the home, for care in the home, and for them to stay in place. It was never meant to be a bank account to go out and buy a boat. That's not what the intent was for. We need to protect those senior citizens where there is a need, where they've had a severe loss of income, but need to stay in the property. Finally, mortgage insurance premiums. I don't have good news. All I can say is we are finally back above, slightly above, our federally mandated reserve of 2%. There is currently no discussion on reducing the mortgage insurance premiums. However, does that mean it will not happen? In all likelihood, it will. When, I can't say. For those of you that have been in the business as long as I have, and every time I hear how long I've been in the business when I speak anymore, I think to myself, I gotta go. You know, it's been long enough, 40 years and another year, it's like, holy cow, are you kidding me, right? I gotta go, but not yet. I still have some work to accomplish. But the mortgage insurance premiums, for those of you that have been around as long as I have, know that it's been higher before. The upfront mortgage insurance at one point, and for many, many years, was at 3.8%. Now granted, there was not a monthly at that time. Then we went to the upfront, which was a whole lot less, with a small monthly mortgage insurance premium. Then we went to, it dropped off at a certain period of time, right? When the two conditions were satisfied, 5 years and 78%. Now we're life of mortgage, okay? But you need to think about a few things. Most people don't hold in the United States, and when I go back to California on Tuesday, I'm going to go do some further research. I want to see how long someone keeps a mortgage in the state of Hawaii, or at least an FHA insured mortgage, right? If they only have that mortgage for 5 years, who cares if it's the life of the loan? Got to put that in perspective. There are protections with an FHA insured mortgage. I don't know if you've had an economist speak to you in the last couple of days, but I'm going to tell you something. If anybody thinks mortgage rates are going to stay at 3.25%, you're probably in the wrong business, right? Mortgage rates have been as high as 18%. They've been as high as 12%, right? There are 3 entities in the country that have assumable mortgages: FHA, VA, and USDA. When interest rates go up, purchasing power goes down. When purchasing power goes down, prices of homes come down. They have to. They have to. Otherwise, you won't have any qualified borrowers at those higher prices. But if you have assumable mortgages, then people can come in and assume that mortgage. And you can help keep prices stable. On that note, I'm going to turn it over to my friends at VA. Thank you.
Thank you for having us here again. So you folks have been doing a great job. This fiscal year we closed $103 billion worth in VA loans. And for May, our interest rate was 3.83 compared to FHA at 4%, conventional 4.15. So I know that it's been a really good product and you guys have been doing really great. Also with COEs, so majority of our COEs have been going through our ACE program, I hope you folks have noticed that it's been issued a lot faster. Those are now being distributed to all of the regional loan centers. Every loan specialist is issuing COEs now, so it's not just done at the eligibility center in Atlanta. We are all issuing COEs, so we have a 5-day timeliness requirement. So if it's not done in 5 days, then we can give our office a call and we can follow up on those. But we've been seeing that those have been a lot more has been done electronically rather than paper COEs, and those are done a lot faster. So I'm just going to give some updates from our lenders conference that we had a few months ago. So the mandatory clause, it's mandatory on all purchase loans. I know that we've had some issues on REOs to get those signed, but it is required. To get entitlement restored on a certificate of eligibility for a previous loan, we're going to need the CD to be signed, and we need to have either an electronic application put in the system or an uploaded signed COE application, the 26-1880. Also, spousal support can be considered a reduction in income rather than liability. Cash out from a refinance cannot be counted towards the required PITI reserve on rental properties. The reserves have to be in the borrower's account before the loan closes. And the live and well statement is not necessary for a spouse if the veteran is signing for the spouse with a POA. A separation agreement will not need to be court signed in states that won't provide it. However, in order to be acceptable in lieu of a divorce decree, the agreement must include a division of debts and assets, any child support requirements, and the division of expenses. And lastly, the business use reported, business use of the property reported greater than 25% on tax returns establishes the rental character of the house, and if it exceeds 25%, then the property will be considered unacceptable because we have a 25% limit. And that's all that I have. Oh, I'm sorry, I lied. One more thing. Okay, so we've been hearing that a lot of you folks aren't starting loan or processing loan applications until you get the COE because you want to have the correct funding fee before starting. We're told that there shouldn't be an issue with changing the funding fee on the LE, and it's allowed and there are no penalties. Our senior management has been in contact with CFPB for this, so you folks can start processing it and be able to make that change later in the transaction without any penalties. That's all.
Hi, thank you for having us. We really appreciate coming out and getting an opportunity to talk with everyone. I just have a couple of quick things. I've been with the VA for 8 months, and during that time we've worked on trying to streamline a couple of the processes that the lenders have to deal with on a regular basis. First, we have worked on streamlining our reconsiderations of value. I know that it's not often that our appraisers tell you a number that you don't want to hear, but when that happens, we have tried to streamline that process. The reconsiderations of value have to go through VA staff. So if you have a question, if the realtors, the homeowners, the purchasers, the sellers want to present more information to try and request the value be changed, please submit that to the VA offices. We'll disseminate that out to the appraisers and anyone else as necessary and get the responses back to you as quickly as we can. Part of being able to reduce the turn times on that is all of our staff appraisers at VA here in Honolulu are now seasoned appraisers. Everyone has worked in the appraisal industry, everyone has run their own businesses, so we have a lot better handle on being able to process the information, what information is relevant, and getting the responses back that we need from the appraisers in the field to make those kind of decisions for you. The other process that we've really worked on streamlining is our condo approval process. We boiled down all the information in our handbook down to a one-page checklist. If you are interested in having a condo project approved, we'd be happy to supply you with a copy of that checklist. Most of the information that we require is available to the borrower as part of the disclosure for purchasing a condo unit. There's very little information that you have to go out and search up and find. We've also managed to get our turn times with our national practice group down to about 2 weeks or less to get an approval back from our legal team. So I know that that is a drastic reduction in the past from what it has taken to get these condo approvals through. So that was another area that we were really working on, getting our services more in line with your industry. We know that waiting 3 or 4 months to get an approval back on a condominium project is not real conducive to closing loans. So we're hoping that with speeding that process up a little bit, we can help you out as well as help the veterans get new projects onto the list as appropriate. Okay. And that's it for me.
Okay, now we will open it up to questions. We have our magic microphone in the middle over here. So if anybody has a question, before the first question, I would like to make a comment though. I would like to thank Nancy once again for coming, and thanks for those tips on the new handbook. We really appreciate that. Those are secret tricks that we didn't know about. The other thing is for both Cherie and Joseph, I just wanted to comment that I have noticed a definite improvement in the past 8 months, I would imagine, or so, the past year, but definitely a real improvement in the turn times for VA appraisals and just the communication and whatnot. It has improved dramatically. That's just my personal comment there. And the same thing with the condominium approval. So it's just a side note for me personally, we really appreciate that extra effort. It's just been wonderful. Okay, we have the first question.
Well, this is interesting timing because I'm Jessica Nagatani, and on behalf of Honolulu Home Loans, I actually wanted to thank both Cherie and Joseph for making our lives easier on the lending side between COEs, NPR requests, even responses when it came to appraisals and values. We can't thank you enough. I think it's made our job easier. So, thanks.
So naturally, we're in a rising market, and we're hearing more and more anecdotal information that, you know, some of the real estate community doesn't want to present for perhaps a VA offer. They're always paranoid about the possible low appraisal. The mandatory clause causes grief. What advice can you give us to deal with those kind of situations? Because obviously we all want to help veterans and help active duty people get a loan, but it seems like the market's turning against some of these people. Do you have any comments that we could use to counteract the situation?
As far as the appraisal values go, there's nothing in the VA guidelines that require that our appraisals be of a lower value than anything else. We also don't have any requirements that are contrary to standard appraisal practice that are going to cause our appraisers to lower their values. The one thing that we do not allow our appraisers to do is set their values based on pending sales. So in a rising market, they do have to support their conclusions with closed sales, but that's the same guidelines that you're going to have in a conventional mortgage as well. The difference is that we will allow on a reconsideration of value if a sale closes after the effective date of an appraisal. You can submit that information directly to the VA and we'll take that into consideration. But having written appraisals myself for the last 25 years, you're not going to have a VA appraisal come in at any significant difference in value than you would for any other conventional appraisal.
Thank you so much. We have one more question, Sean?
Yeah, Nancy, could you enlighten us on FHA's position on unpermitted additions on a single-family home and how they would be handled if they are allowed going forward?
Yes, I can.
She is gritting her teeth before she answers that question.
It's, all right, so, unpermitted room additions. The appraiser is to address whether they were built in a workmanlike manner free of health and safety issues. If the appraiser is counting the room addition as gross living area and wants to get value as gross living area, and thankfully I have an appraiser up here with me, then they've got to provide comparables with equal unpermitted room additions. If they cannot do that, then they must give no value to the unpermitted room addition. And if it's in there, the lender's underwriter, the direct endorsement underwriter, is supposed to subtract it out of the value. So you can, but you can't, right? How many, when there's a sale, the appraiser most likely won't know that the comp that they're using had an unpermitted room addition, right? Because it's not recorded. So it could be a challenge. However, if you know, in fact, that there's an unpermitted room addition, and the appraiser can go back and look at those, because you have them on the MLS, there's recorded documentation. If you can justify using that, if the appraiser can justify using that as a comp, and again, it was built in a workmanlike manner, no health or safety issues, then you very well may be able to give it value.
Now, otherwise you just back it out of value and it's...
Otherwise, you just back it out, and ultimately that, right, you're gonna lend on the sales price or appraised value, whichever is less. So, yes, but again, it's gotta be built to the workmanlike manner, no health or safety issues, okay? I also wanted, let me do one more thing. I wanted to provide a clarification on the student loan calculation, because I'll tell you right now, you got people out there that still don't know, understand. That mortgagee letter was not written as clear as it could have been, and I need to make it clear for you today so you don't throw potential borrowers out because of it. For student loans, no more deferred debt, no more zero payment. Some payment has got to be used. You will use either 1% of the outstanding balance or the payments reported on the credit report, whichever is higher. However, you do have one more option, and that's to get the actual loan document that evidences the payment, and if that payment fully amortizes over the term of the loan and the interest rate, you may be able to use that payment, which could be less than the 1%. Or the payment reported on the credit report. The way the mortgagee letter was written, it gave you, because they stuck an extra or in there by mistake, so it said the greater of this, or this, or this. And that was not the intent. It's the greater of the credit report payment or 1%. Or if you can document a lesser payment through the note and it fully amortizes out, then you can use that payment instead. Okay? So I wanted to make that clear. Hopefully that answered your question on the appraiser. Thank you.
You had a comment, Joe?
Yes, I'd like to add a quick comment. Our rules are a little bit different on unpermitted areas for VA. The VA guidelines state that when appropriate, we have to follow local guidelines. For the state of Hawaii, they do require permit for any kind of additions, especially if it's going to include plumbing or electrical. So if the area is unpermitted from the state or from the city and county, it's not acceptable to VA.
Okay, well, thank you very much. We are going to move on to our next speaker, but I just wanted to say a couple of things. Nancy has left some handouts on the table at lunch, so at lunch be sure and take some of the handouts, bring some back to your offices. I'd like to thank our panelists once again. You know, the amount of value that we get from your trip, Nancy, flying all the way here, and for Cherie and Joe, the amount of value we as a group get from you coming here is just huge. Last year we did a survey amongst our group here, and we all gave Cherie a list of how much we pay for conventional appraisals. She was able to take that information. I don't think your appraisal amounts changed as a result of that, right? Pretty much the same?
No, so we were getting a lot of complaints, and I mean, we do listen to you folks, and we don't want to take ourselves out of the market. So at that time, we knew that our appraisals were taking too long. We're getting complaints about certain appraisers. So we try to address all of the issues that you folks bring to our attention. And that was the reason for that survey last year, and thank you for that. So I hope you folks, I mean, we did make that change. I'm sure you folks are all aware, but we do try to work with you folks to do VA loans.
Yeah, it was very valuable, and the input that you get, I mean, we've just, I see a bunch of nodding heads. There's been a huge improvement, and we, as a group, thank you for that. And so we'll be trying to get you back here next year, because compared to 3 or 4 years ago, the question and answer period after this panel was rather lengthy and rather negative, if I recall properly. But anyway, very positive. It's unusual to have everybody lining up to say what a great job you're doing. All three of you, we really appreciate it. Nancy, we have a face, you know, for our VA questions. We get the tips and tricks. There's some handouts on the back, so please, as a group, a warm thank you and a warm round of applause for our panel. Thank you so much.